Morning, everybody. Happy Tuesday. It's 10 a.m. on Tuesday. Good to see everybody. So long day for me today. So started with this webinar and then we end one of our classes tonight. And we have another series of classes starting on June 9th. So you all will receive an invitation, as you always do, to the upcoming class. Many of you had said that, or some of you had said that you couldn't attend this last series, but you're looking forward to another. So I'm looking forward to a good long day today. I'll be wrapping up at about 9:30, 10 o'clock tonight. Well, about 10 o'clock, I guess. So let's jump into it. So we're going to go over, I just want to remind everybody that you are muted. You do have you should have a Q&A section at the bottom of your screen there. Feel free to ask any questions as we go. This webinar will be or is being recorded. I'm hoping you're seeing the recordings on the website and on YouTube, and you can subscribe, just like everybody always says. I'm supposed to remind everybody to subscribe to the YouTube channel so that you can keep track of the videos as they come out. So I hope you're enjoying these. So we as I said, we have another class coming up on June 9th and the 14th. These will be a little bit different this time. There'll be webinar classes, but there'll be a series of 3 for each evening, 3 on Tuesdays, 3 Tuesdays, 3 Thursdays, 2-hour classes. We're just going to try to mix it up a little bit to see which type performs better. We're going to talk about, we're going to have some slot updates, and we're going to also talk about some market updates with just a couple analyst reports. It was kind of slim pickings this week, and then we're going to get into our financial planning topic. And our financial planning topic is what happens to tax rates in 2026. Now, this is not a crystal ball kind of discussion. This is the current legislation, the way it sits right now. I think all of you know that taxes are set to change back to the 2017 tax code. You hear this a lot, the sunset of the Tax Cuts and Jobs Act, the Trump tax cuts, whatever you want to call them. But I want to show you what that really means. I think it's important to have an idea of what that looks like. So that's what we're going to discuss in our financial planning topic. So as always, let me just check in with everybody. So first of all, good crowd here this morning. Good to see everybody. Raise your hand. So click your raise hand button if you can see me and hear me. Okay, thank you. Very good, everybody. I appreciate the participation. Okay, so let's jump into this. So I'm going to share my screen here in a moment. Well, I'm sorry, headlines. So I just leave the Russia-Ukraine headline here because it seems like, I think I've said this before, but it just seems like we're not hearing about it enough, and that concerns me. So I just want to remind myself and everybody out there that there's still this horrendous thing going on in Ukraine, and it certainly is causing quite a few issues around the globe economically, as well as all this uncertainty. So don't think for a minute that the market shocks that we're seeing isn't because of uncertainty. Nobody really knows. Everybody's kind of scratching their head, including these high power, high dollar analysts and money managers, right? So, we've been very fortunate with our group here, very lucky as far as timing in certain areas. That's, and again, the structure helps too, the asset allocation, principal protection, and account segmentation, for sure. You've all been witnessing that. But it's a scary time, folks. The gas is much more expensive. Food is much more, our basic staples. I was with a group of individuals yesterday, mostly seniors, last evening, and there's a lot of folks very, very concerned about how they're gonna pay for things. So we can't just set that aside. We've got to be vigilant about this and do things that we need to do to make adjustments for our own retirement, our own planning. Planning is vitally important. I've been telling you that as we've been adjusting our inflation numbers up and we've been ramping our investment return assumptions down, we're seeing plans start to fail, and that's a concern. And you've especially if you're just entering retirement, or even if you're deep into it, these are things we have to watch out for. And this is why we have to review these plans every year. Okay, so one headline I want to talk about, in addition to Russia, I came across this this morning or yesterday. Goldman Sachs just downgraded their 2022 U.S. growth forecast to 2.4 from 2.6, and 2023 to 1.6 from 2.2, as senior chairman Lloyd Blankfein warned of very, very high risk for a U.S. recession. So I've talked about recession a lot over the past few months. Strong concern of mine, even including 2022. Recessions aren't something, in my experience, that we say, here it comes, here it comes, here it comes. We say, all right, here we are, right? Suddenly the indicators are there and we're in the middle of a recession. The question is, how long does it go? What are the effects? We have some significant headwinds. So we talked about CPI, Consumer Price Index, last week. So we're at 8.3 compared to 8.5. So people are happy that's headed somewhat down, but 8.3 is just pretty outrageous. Can I sustain it? And the concern, of course, with the Fed is that they're not going to be able to act fast enough now that they're kind of catching up, without doing significant damage to the overall economy and really, really shaking things down worse than they are now. All right, so let's get into the Slott updates. Listen, this is fine, by the way. If you're set up right, it's not going to obliterate your retirement. If you're a very risky investor who tends to have all their money in stocks, and people have done very, very well with that. I've had conversations with people over the past several years. I remember one fellow in particular I'm thinking of. He says, well, why would I want to hedge some of my money and save for investments, principal protection, or slide things more conservatively in their asset allocation model, when I can average 10-15% pretty easily? I remember him saying in my stock investment model, and probably even more than that. Well, I'm sure he's feeling it right now. So the question is, for how long? Listen, it's always good to make sure your funding is in the right places for your retirement. We don't want to get too greedy, folks. All right, let me share my screen because we're going to get into Slott updates. And I had a great suggestion by one of our regulars, Kathy. And Kathy, thank you if you're on. I did make adjustments to the survey that populates every week, and I do appreciate people taking the time to answer those surveys, and we review them and see what areas you're most interested in. So that's appreciated. So I'm hoping you're seeing my screen right now. You should just see my notes. Just raise your hand if you see Ed Slott updates, Monday, May 23rd. Thank you. So this is in front of you because so you can follow along, because this is a lot of information, and one section in particular is going to be quite a few paragraphs from the workshop that just happened in Kansas City, I think it was. I wasn't at that one. I got an excusal from, or I was excused from Ed. I had a conflict that I could not make. I will still have to take the exam and go over the material for sure, though. We have to take an exam within a few weeks of the end of the class. So Sarah writes, why is it important to know how the once per year rollover rule works? Well, that's because trouble with the once per year rule is the kind of trouble no one wants. An IRA owner who violates this rule is looking for some serious tax consequences. So I put this on here as a reminder. So I shared with you a week or two ago that we often have folks who say, I'll handle this. They're transferring funds in or rolling funds over from a 401k. And while we appreciate the help with that, it almost always ends up being an issue. So there have been times when clients were able to execute it fine on their own, but there's no reason for you to do that. You're not saving us any time. You may be saving us a little bit of time, but you're potentially creating a significant amount of work, extra work, and potential cost for you. So let us handle it, because these are things that you can run afoul of, these once per year rollover rules. And one of them that gets, and Sarah will talk about this, I believe, is that IRAs and Roth IRAs are aggregated, right? So people think that you can do a once per year rollover for your IRA, traditional IRA, and then do a second one for your Roth. And that's not the case. So, and I'm not talking about, I'm talking about transfers or typically what's called a rollover, when you take possession of your funds yourself and then deposit it into an IRA. So if an IRA owner, for whatever reason, elects to not do a direct transfer, that's the best way to do it. You name the custodian, right? Charles Schwab for the benefit of so-and-so. And then the funds go right into the IRA. Even if you receive the check, you can't deposit that check. So the IRS says you really never had ownership of it. So if that check sits in your drawer for 60 days or 90 days or 120 days, you haven't violated, first of all, the 60-day rule, and you haven't even created a real rollover for this direct, an indirect rollover, right? Or right to you rollover. The term is escaping me. You haven't even done that. You've done a direct transfer. So this once per year rule doesn't even apply. So it's the best way to do it. The IRS says that an IRA owner cannot roll over an IRA distribution that was received within 12 months of a prior IRA distribution that was rolled over. So it's not January 1 to January 1. You don't get a new one. You can't do one in December and then do a new one in January. There are some things you can do that with, right? And some tricks we can play with. Well, if you take a distribution and like for tax year, take a distribution in December, I've had clients that say, I suddenly need $100,000. Well, can we split it up between the two, between December and January? And sometimes that helps with their tax payment. But you can't play that game with these rollovers. The once per year rule is a 12-month period. Traditional and Roth IRAs are combined for purposes of the once per year rule. Let me stop scrolling and get there. A distribution and subsequent rollover between your Roth IRAs will prevent another rollover of a traditional IRA received within 1 year from receipt of the Roth. The bottom line is that only one IRA to IRA or Roth IRA to Roth IRA 60-day rollover rule may be done if the distributions are received within 12 months of each other. So what happens? Well, if you do another rollover within that period of time, even if you deposit that money within the 60 days that you have to do it, you're fully taxed on that distribution. So if you think about that, if someone says, well, I've got this IRA over here for $10,000 and I have this other IRA over here for $1 million. Let me do a direct rollover, or excuse me, let me do a regular rollover. I'll take the check and then I'll figure out where to go with it. And I want to handle this on my own. And then they end up putting it in a Schwab account with us. So that $10,000 if it's done within 60 days is fine. Now they say, okay, I like this. I understand what you're doing. Let me take this other $1 million and I know how to do this. I'll pick up the phone and I'll call Fidelity and they'll send me the check and then I'll deposit it with you. Everything will be fine. So they ask Fidelity for the $1 million and Fidelity sends them the $1 million. And then it could be the very next day they put it into the IRA at the Schwab account, let's just say, and they're going to pay tax on that entire IRA distribution because they've done two within a 12-month period. So be very, very careful. A mistake within a once per year rollover rule can result in the loss of your retirement savings. It's a fatal error with no remedy. I don't know if it would result in the loss of your entire retirement savings, but you're paying cash on a significant amount of money, or paying tax on a significant amount of money you don't need to. If an IRA owner takes a distribution with the intent of rolling it over and discovers that she is ineligible to roll over the funds due to the rule, that distribution will be taxable to her. She will no longer have an IRA and will likely have a tax bill instead. The distribution will also be subject to a 10% distribution penalty if the IRA owner is under 59.5. Very true. If she goes ahead and deposits the funds anyway, she will have an excess IRA contribution complete with all the penalties and headaches that go with that. Yeah, that's another issue. If you put it into the IRA, you have an excess contribution. Now it's considered a contribution, not a rollover if it violates the once per year rollover rule. And now you have to undo that. And there's a penalty that's potentially associated with that. And it's a real pain in the neck. The self-certification procedures will allow for relief when the 60-day rollover rule deadline is missed. But that does not apply to violation of the once per year rollover rule. A private letter ruling request won't work either. These PLRs, private letter rulings, I think the minimum fee for that now is $10,000 anyway. Direct transfers are the way to go. Why chance? A good place to start is by avoiding a 60-day rollover whenever possible. If there's no 60-day rollover, then there's no once per year rollover rule to worry about. Yes, those two are completely linked together. So be careful. How then can you move your retirement funds? The best advice is to directly transfer the funds from one retirement account to another, as I said before, instead of taking a distribution payable to yourself and then rolling it over to another retirement account. You can do as many transfers between IRAs annually as you want. There are no limits to worry about. So this may sound very, very simple, but again, smart people get caught in this all the time. So ask for guidance, ask for qualified guidance. People in these other firms make mistakes on this all the time. We get, when we're going through these training courses, you see case law of people at, the big firms, the big Wall Street firms, the small firms where they do it incorrectly. I've had attorneys transfer estates, IRAs into estates incorrectly. I've had all kinds of issues. All it takes is a phone call before and the patience to say, let us help you do this. All right. So here's a list of some of the topics of conversation from Kansas City. I really like this. So this is by Andy Ives. Last week in Kansas City, the Ed Slott team hosted our first in-person training program for members of our elite advisor group since late 2019. That's me, part of that master elite advisor group. While we managed to stay in contact with everybody via virtual meetings for the last 2 years, it was good to see everybody face to face. Throughout the program, we focus on a number of current topics like nuances of the 10-year rule for beneficiaries. This is a whole new ground for everybody. So, we got some direction from the IRS a year ago, and we got some misdirection from the IRS about a year ago, and then we got some clarification by the IRS in the summertime from the IRS, and then we got regulations from the IRS a short time ago that are, and all of these three things have been conflicting. So, but the regulations stand for now, but it's all new uncharted territory that we're all working through. And so you've got to make sure you're doing it right. Like the nuances of common mistakes made when setting up inherited IRA accounts and the advantages of Roth IRAs and Roth 401k plans. Some of the questions and topics that bubbled up organically across all retirement account subjects include the following. So let me bring these up. Can a spouse beneficiary do both a spousal rollover and an inherited IRA? Yes, it is recommended that a spouse who is under 59 and a half do an inherited IRA with a deceased spouse's account. Of course, that's going to be different for everybody, but that's general good advice. This way, she can have access to the funds without the 10% early withdrawal penalty. Once the surviving spouse reaches age 59 and a half, she can then do a spousal rollover. However, if the surviving spouse wanted to do a spousal rollover with a portion of the inherited funds before 59 and a half and leave the rest as an inherited IRA, that is perfectly acceptable. Why might a spouse under 59 and a half want to do that? It's because in this case, they're using she. In this case, the person could have access to those funds without a 10% penalty. So an inherited IRA will allow you the flexibility to maintain the tax deferral, but you can take funds out and you'll pay tax, of course, but you won't pay the 10% penalty. Once you roll over those funds into a spouse can treat an inherited IRA as his or her own. Once those funds are rolled over to a rollover IRA treated as their own, then they're subject to the rules, the IRS rules of under 59 and a half distributions. The benefit, of course, is that they then can convert those funds to a Roth IRA if they want to, something that cannot be done in an inherited IRA. So it's not as cut and dry as what Andy's talking about here, but it's generally good advice, but always worth a detailed conversation. How does the stretch IRA work for an eligible designated beneficiary or EDB child? The new regulations clearly define the age of majority for IRA beneficiary purposes as age 21. So it's not 18 for these purposes, it's age 21. Also, there is no longer an extended age for anyone still in school. That language has been removed. That is an important update. Also, that is something that most people, it's not even discussed generally yet. A minor child of an IRA owner as an EDB is permitted to stretch required minimum distribution payments over the child's own life expectancy until the year she turns 21. After that final year, the 10-year rule springs forward. So you see how confusing that can be. So especially when you're combining terms like stretch over someone's life expectancy. There's a difference between life expectancy and lifetime, right? Because this says if an 18-year-old child inherits a inherited IRA, they can then go to take distributions based on the life expectancy table, the IRS life expectancy table for inherited IRAs. But then once he or she turns 21, well, now they fall under the 10-year rule, and it has to be depleted within that 10 years. Of course, it can always be taken out prior to that. Person subject to the tax, but if they want to delay that tax and there's withdrawals, then they can take those over life expectancy until they turn age 21, and then it's the 10-year rule. And no, they cannot be converted to Roth. So do former 401k plan dollars rolled into an IRA have to maintain the spouse, drop down one, as beneficiary? The answer is they do not. While IRS rules dictate that a spouse must be the beneficiary of the 401k unless the spouse consents, there is no such spousal consent rules for IRAs. So a lot of plans actually require the spouse to sign off before there's a rollover. That's been it used to be a notarized signature when I first got into this, but 20 some years ago. But now most things are done over the phone, so I don't see that as much anymore. Next question: when does the 10-year rule start? And is there still a year of death RMD? If the original IRA owner was subject to lifetime RMDs, so if they had hit their required beginning date, and if that original owner had yet to take the final RMD, then the beneficiary is responsible for taking the year of death RMD. If the beneficiary is subject to the 10-year rule, the 10 years start with the year after death. So it's essentially a full 10-year term plus whatever time remains in the year of death. When trying to determine the final year in the 10-year term, start with the year of death and then count them on your fingers. There's no shame in that. That's funny. Is the dependent child who has his own earned income potentially phased out for a Roth IRA by his parents' income? No, if a dependent child has his own earned income from anything from lifeguarding to washing dishes to stocking shelves, and if that child files a tax return, Roth IRA eligibility is based on that child's income, not the parents. Conversations also included details about the new successor beneficiary rules, life expectancy tables, consideration when moving money from a Roth 401k to a Roth IRA, 72T schedules. 72T is a part of the IRS code that allows somebody to take funds out of an IRA prior to age 59 and a half. There's a very specific schedule you have to follow, and there's a very specific timeline you have to follow. Trust beneficiary rules and much more. It was a long and informative few days, and we look forward to our next meeting, member event in October in Las Vegas. I plan on being in Las Vegas. Not my favorite place to visit, but we're going to try to have some fun about it. So now I pulled one question from the Slott report mailbag. So this question was, and who's answering this? This is Ian who's answering this, who you've all met. The question is, hi, Mr. Slott. I read somewhere that if we need to withdraw a required minimum distribution, RMD, but don't need the money, we can convert this RMD to a Roth IRA. Is this true? I wish I covered up the answer to this, because I hope you would all be screaming, no, because I hope you all know by now that no, you cannot convert an RMD to a Roth IRA. Why? Well, because that's what the rule says. It would make sense to be able to do that. It's a distribution, you're paying tax, move it to a Roth, but the IRS won't allow it. You can, of course, use it to pay the tax on another Roth conversion. But if you have your RMD that's $20,000, and you do a Roth conversion for $100,000 and you do them simultaneously, the RMD is going to be considered to come out first. So that's going to be a distribution. So you're going to essentially be converting just $80,000 of the Roth. So you've got to take that into consideration. So Andy said, no, that won't work. As everything I just told you, a conversion to a Roth actually is a rollover. And RMDs can never be rollover. However, once the RMD is satisfied, any additional withdrawals could be converted to a Roth IRA. So be careful. That's something that's often confused, hopefully not by this group. So I hope that was helpful. Your Slott updates for the day. Okay, let's talk about the markets. So my usual go-to sources of market data, Invesco and First Trust, are just nowhere to be found this week. So usually I get them by early Monday. Here we are, early Tuesday. I still haven't received them. That often happens on a market holiday, like we're going to have this coming week on Monday, Memorial Day. There will not be a webinar on June the 7th, just to give you a heads up. So that's 2 weeks from today. So there will not be a webinar on June the 7th. I have a family commitment and I am not going to miss it. Sorry, but there's always recordings if you miss me. So, I talked about recession fears, and that's built into this. Following weak earnings, the headline is recession fears grew last week following weak earnings reports from major retailers, sending stocks lower. So this is week ending for last Friday, which was the 19th, I think, the 20th. So Dow Jones Industrial Average was down 2.9%, and the Standard & Poor's was down 3.05%, and NASDAQ dropped another 3.82 for the week. And the MSCI EFA index, just broadly international stocks, developed overseas stock markets, gained 0.84. So where does that leave us? I'll share the snapshot with you here, make this easy. Here's a simple snapshot. So this is the Dow Jones Industrial Average. So this is it for the week ending Friday, down almost 3%. Year to date, down almost 14%. This is big, folks. This is a big rout, right? I said that before. Hopefully we've done the work for you. If your clients, asset allocation, principal protection, account segmentation, so you don't have the dread and worry that a lot of people have. You've seen us making moves, putting things into cash. Thankfully, we did some movements in late April for bond funds, and that's helped a lot. But this is what we're dealing with. I worry less about stocks. I've shared that with you. I worry less about stocks. I worry more about the bond market and the time that it's going to take to recover. But the NASDAQ hurts. It's down 3.82 for the week, down 27, almost 0.5% for the year. The MSCI index, we talked about that. That's the global stocks, developed markets. That was up slightly, and it's still down 16.16%. And the S&P 500 is down 3.05 and down 18.14% for the year. And then down here, you see your treasuries. The 10-year treasury, that was down 0.15%, up. So up though for the year, 1.26%. So that's your market snapshot. How do you feel about that? What's BlackRock saying? BlackRock is turning neutral on developed market stocks. So remember that they've been saying, well, we're still positive domestic stocks and developed market stocks, and we expect that there will be still a good recovery in the economy. So that's been the discussion. Now they're saying they're neutral on a risk of the Fed talking itself into an over-tightening policy and China adding to a weaker global outlook. All that makes sense. They write stocks plumbed new 2022 lows on fear steep rate rises will trigger a growth slowdown. That's a fear I share. We see a brighter picture, but this may not become clearer for months. And then we have some more inflation data coming up. And we also have, I'm starting to see people with some more COVID mitigation lately. Did I stop my share? I hope I stopped my share. Yes. We see some more COVID mitigation lately. We're talking about monkeypox now. So there's again, just a lot of uncertainty. Hopefully we don't have to shelter in again for anything like monkeypox, right? I don't say that lightly. I'm just saying it kind of out of frustration. So the answer to all these things is, of course, reviews, financial plans from a investment point of view, asset allocation, principal protection, and account segmentation. So for those of you who have taken advantage of principal protection allocations in the past, don't you feel good about that now, right? Because typically and historically, people would offset the risk of stocks with bonds, and bonds, that wasn't on this sheet that I share with you today, but the typical bond index is down about 11 to 13% right now. And that's painful. And you saw the stock indexes, right? So it's down just about as much. So very, very challenging. But we want to stay optimistic, and we want to stay defensive. All right, let's talk about our financial planning topics. Any questions before I move on? No questions. Okay. I'm going to share my whiteboard with you. And we are right on time. So hopefully I don't get too crazy with this. Okay, we talk a lot about, I'm going to be looking down. Just raise your hand for me if you can see my whiteboard, okay? All right, thank you. And I've said this before, if Bill Gates is listening, I cannot stand this Microsoft whiteboard update. It is just messy and very, very sensitive, where I used to be able to rest my hand on my tablet. Now I have to kind of hover above it to write on it. So I don't know what they've done, but I don't like it. So here, we talk a lot about the changes in tax rates in 2026. So whether someone says is it 2025 or is it 2026? Well, it's pretty much the same thing. It's 12/31/2025, which means that's when the Tax Cuts and Jobs Act sunsets, which means the new tax code, if Congress does nothing, takes place it reverts back to the old tax code at January 1st, 2026. So it's the same thing. I had somebody kind of challenging me about that. So what does that mean? So let's first talk about this sunset provision. So what is a sunset provision? So let me just write that here. So sunset. What is that? It's simply a method to bring people aboard that when Congress is trying to pass a bill, which they were trying to do here, and it was actually the president's at the time, President Trump's at the time, his initiative. He wanted to reduce taxes, across the board, and this, and when there becomes discussion, right? And the discussions often revolve around, well, that's, this type of tax cut is acceptable to me, this isn't. But many times what happens is there'll be a provision where there's a sunset provision. So it allows Congress people to say, okay, I'm going to vote for this, but I know it's going to end at some point. So instead of this Tax Cuts and Jobs Act running into perpetuity and then requiring congressional action to change back to 2017 levels, because that was really the Obama administration tax code. So Trump wanted to replace Obama's tax code with his own tax code. And I'm not saying either one was good or bad. I'm just giving you some history. To earn that ability or have that support, they had to put an end to it. If you do nothing, if Congress does nothing, then it reverts back to 2017 levels. So it's just kind of a trade-off, because many elected officials aren't keen on doing something like this that's going to affect us forever. And it's going to take some big action, right? Because a congressional action is a big action. It's going to take some monumental, it's going to take an act of Congress to make this change again. So here it automatically reverts. I hope that makes sense. So Congress just has to do nothing. And if they do nothing, then the current Tax Cuts and Jobs Act, this is called Tax Cuts and Jobs Act, reverts back to 2017 planning tax levels on 12/31/2025, which is pretty much the same as 1/1/2026, right? Because that is really a holiday, so it's pretty much the same day. So these are really the same thing, 2026, 2025 for these purposes. I'm sure there's something that happens in between there, but for our purposes, it's the same. So what I did is I took these charts and I put them side by side. Now, why can't I scroll? Well, all right. Bill Gates, help me out here. Okay. So I put these charts side by side. So obviously this is the 2017 chart and this is the 2022 chart. So this chart you can get on my website, www.attleborowealth.com. And you go under the slot corner and scroll down, you can grab these charts. This one you can't. And I actually can't. I went on to Ed's website a few weeks ago because I was talking about this with somebody, to grab this 2017 tax planning chart, and it's gone. I can go back, I think, to 2019. So thankfully I had a copy of this, and I had it laminated, because at one point I had, well, this one has 2019 on one side, 2017 on the other side, because I was using it as kind of a comparison. So thankfully I still have it, and you'll see I have a note on the side here. And that note is what my calculation was for the top of the 28% bracket here, in what I believe it'll be roughly. Now it's probably going to be much different actually now because of inflation rates, but what I thought it would be come the end of 2025. So that's simply what that note means. All right, now unfortunately they changed. What I wanted to share with you is really what the big changes are between these two structures of tax code. Now, unfortunately, they've inverted this. I like the way they used to do it, right over here, where they start it with the lower number and they go up to the higher number. That ascending in that order, I guess descending from the top, ascending from the bottom. So I don't know which is correct. Somebody will tell me though. So I like this though, starting from the bottom, starting from the lowest, going to the highest, because we use that graduated cylinder comparison all the time, and we go from 10% up to 37% where we are now, and we talk about your income filling in this graduated cylinder, so it makes more sense for whatever reason now. And I'll have to ask them. The Slott group now has inverted this, but it is what it is. So what I did is I just plucked these out. So I grabbed these sections that I want to talk about and I moved them down here. So come on, there we go. All right, so I cut them out and I moved them down here, and I want to show you the big differences. So the thing that everybody talks about is this, the top marginal tax rate, right? So here it's 37%, and I promise you it is the top, even though it's showing us the bottom here. And I'm sorry, I've switched these, so because I want to show what's going. So I probably made that a little more confusing. So 2017 is over here, 2022 now is over here. Because the reason I did that is because things kind of flow right to left to right, and it just felt more natural. So your 37% bracket goes back to 39.6%. So you might say, okay, that's not such a big deal. And this is for right now, this is for people married filing jointly. So pay attention to these differences here, married filing jointly and single. So, and I just have to say that you always have to remember this, is that none of us get out of this life alive. And if you're in retirement with a spouse, it's likely that at some point you're going to be filing as a single taxpayer. So if you just compare the differences, let's look at 10%, from 0 to 20,550 for a married filing joint couple, and from 0 to 10,275, you're in the 10% bracket for a single filer. So you'll see the taxes double really right there for you fundamentally, because the income rate drops in half. So maybe even if they don't double for you, they increase significantly. And that happens in every step of the tax code. So let me just back those out. So everybody talks about this, the top of the code, 37% compared to 39.6. And some people might say, well, that's only a 2.6% difference, right? So that little triangle for difference or delta. So the difference is only 2.6%. Is that really a big deal? Well, the big deal is that we go from $647,000 back down to $470,000 for a married couple filing jointly, and for a single filer, it's $418,000. And some people might say, that's a lot of money. How many people is that really going to affect? Well, that's a good point. But if we look at the middle here, I want to look at the middle bracket. So 22 becomes, let's look, and again, I wish these were different, and I can draw them differently if you want, but the 10, we're going to bring this over here, that stays the 10, right? The 12, follow the line, goes to 15. 22, follow the line, goes to 25. 24 goes to 28. 32 is fun, isn't it? It's like elementary school. Goes to 33. 35 stays at 35. Okay. So the biggest change is really right here, isn't it? Right in the middle. And that's just the percentages. Pay attention to the income. So let's drop down here. I want to make this a little clearer. So we're going to focus on the 22, and I'm going to do these upside down, 24% and 22%. And this one's the 2022 tax code until the end of 2025 or the beginning of 2026. And this is 2017 tax code. That's what it's set to revert to, adjusted for inflation numbers. I should say to be adjusted for inflation, because the numbers we have are not adjusted. So we have the bottom of the 22% and the top of the 22%. So I'm going to list those here. So currently the bottom of the 22% is from $83,551 to, now these are married filing jointly. I'm not going to do both married and single. You can reference these charts if you'd like for that. But for right now, I'm just going to show you right here the married filing jointly to 178, 150. So that is the range for the 22% marginal tax rate. 24 goes from 178,000 to $151 to $340,100. Big span. And we often talk about, look at that. Look how much more money just for 2% that you can convert in your Roth IRA from $178,000 to $340,000. And that's our sweet spot, right? We do a lot of work, and most of our work right here, fill up to 22, often fill up that 24% bracket to be able to really move a lot of money. Now, all's not horrible, because I see some questions. All's not horrible because I started doing Roth conversions in 2012. So we were doing Roth conversions from 2012 all the way up through and including 2017 until the Tax Cuts and Jobs Act changed. So it's not terrible, but I want to show you the difference. So now let's take this. And 22% doesn't exist under 2017, does it? No. It is now 25%. And 25%, pay attention to the income. The income starts in the 25% marginal tax bracket from $75,901 to $153,100. Right? So that's pretty close. It's likely this will be closer to 178. It might be 160 or so by the time we get to 2025. But that one's pretty close, but you're plus 3% in that bracket. That's a lot. Now, here we go. Next one is 28%, but watch the income. So we're plus 4% here. That's a lot, because think about it. You're plus 3, plus 4 there, right? So that's a significant amount. Now, here's the income. Remember, we go from 178 to 340 here. Well, here we start at 153,101, and we go to $233,000. So even adjusted for inflation, we've shaved close to $100,000 off of this top tier. And this is where most of the pain, I believe, is going to be for your middle class taxpayers. And then we can add on to here. So we add the 33% bracket here, and that is 32 here. So that's plus 1. But again, the income levels are so different. 33 starts at $233,000. That's really easy to cross into for folks in our area. And certainly when you're doing Roth conversions, $233,000 to $416,000 in the 33% bracket. So this is tough. This is 33%, makes it very, very difficult for the math to work with Roth conversions when you're filling that up all the way. Sometimes when you just cross into it a bit, it's okay. And for some people, it makes sense to convert at higher levels. But I'm hoping you're seeing here that where are my pens? That the real challenge for most folks is going to be right in this category here. So going back here, it's really the middle. And that's why we talk about these, it's really going to affect middle class America. And with all of our work, remember, we fully expect that the middle class, average middle class American will be in the 40 to 45% effective tax rate in the next, 10 years. And you can see how that'll happen because it's so much creeps up. So remember, and that is just 2017 and the Tax Cuts and Jobs Act. But don't forget, the Congressional Budget Office says we should be looking at 25. I believe it's 62 and 88%. It might be 64, but those are dangerous areas. We're going to get there at some point, probably around 2030. But what we're looking at legislatively as it stands right now is just the reversion to 2017 levels via the Tax Cuts and Jobs Act changes. So I get a lot of questions about that. It comes up. I hope that was helpful. Let me check our questions. Just put this up here. There we are. All right, Doug. Hey, Doug. Well, the standard deduction in 2026 also changed, as that can also impact many. So, Doug, it's been a little while. I think you asked this before, and Walter asked the same thing. So you guys are on the same page. So it used to be a standard deduction and personal exemption, and then it was combined to be a standard deduction. So I believe that it reverts back to a standard deduction and personal exemption. So Walter asked what that is. So let's see if it should be on this 2017 tax chart. And it's not, unless I'm just not seeing it. I don't see it on here, but I can do some quick research and see. But you'll see, you can see here that it's currently on the other chart, the 2022 chart right over here. I thought it was on 2017 as well, but I guess they added some information onto there. But the standard deduction and personal exemption, when it came together to be a standard deduction, really was very similar, nearly the same. So I don't expect if it reverts back that it's going to have that much change as far as the amount. But I'll do some research on that. Good question. All right, it is 10:48. I hope this was helpful. Always great seeing you folks. Let me close out these. You're going to get a survey, as you always do at the end of this, and I appreciate you taking it. Let me know how this webinar was, and if there's any material you'd like to see in the future. And otherwise, we'll see you next week. Have a great week and take care. Happy Memorial Day. Take care.